Assalamu alaikum. This is lecture 44 of Advanced Cost and Management Accounting. We are discussing the topic of capital budgeting. The techniques of capital budgeting. We have said that capital budgeting is making decisions about projects that have a longer term duration and implication. And we said essentially the cash flow in a conventional way occurs at the present time or the current time, which we call period zero, and the outlay, and that is the expenditure, which is the capital expenditure, and the return of inflows continues for several years or several periods in the future. We have been discussing how to decide which one to accept, which one to reject, how to build criteria for accepting or rejecting the different projects a company might face. We discussed the concept of NPV as one technique for deciding which project to choose. Net present value is the NPV, and that is obtained by discounting the cash flows to the current period or the present time, and then comparing the cash flows and the net amount, and whichever gives a higher net amount is the project that the organization should accept. Today we are going to talk of one other technique, and this is the IRR, the internal rate of return. The internal rate of return is one other commonly used technique for evaluating projects, for evaluating investments, seeing what returns are being generated by the investment, and therefore, first of all, whether or not an organization should accept a project, and secondly, if they do accept, which one should they accept. The internal rate of return is an alternative technique used in making investment decisions. The IRR represents the true rate earned on an investment over its economic life. So we have said that the internal rate of return is the true rate which the investment has earned. It is the calculation of what return we are getting over its estimated life, over the economic life of the project. What is the rate that you have earned? So it is taking into account the cash flows as they occur over the life of the project. Capital budgeting decisions will require that we should select projects that provide us a return which is suitable and acceptable to the organization. Now, what should be the return that should be acceptable to the organization? We mentioned earlier that we can compare to the financial results and the financial returns that are available from investments in the markets. Markets such as the stock exchange, the treasury bond, government bills. Whatever return we can get from that can form a benchmark, a basis upon which to decide that if we invest this amount of money in this project, then do we obtain a return which is either equal to or in excess of what the return available in financial markets is. So the internal rate of return is going to be compared with other possible returns available in order to decide whether or not to accept projects. Very often, companies will have what we call their own cost of capital. The cost of capital is the cost of funds for obtaining the funds to engage and invest in projects. So the company will make the decision and compare the IRR with its own cost of capital in order to make the decisions about investment. IRR is that rate which gives the NPV equal to 0 for all cash inflows and cash outflows when discounted. So what does this mean that NPV is equal to 0? We have discussed that NPV, the net present value, is obtained by discounting the cash flows to the present time. So some rate is going to be used for discounting. We used an example with a 10% discount rate. Now, NPV is going to be equal to 0 if you use a discount rate that will equate in present value terms all the cash inflows and the outflows. That is the rate which will give NPV 0, and that is the rate which is the IRR, which is therefore the rate which is being earned by the project. How to arrive at that rate which is going to give NPV equal to 0? Here, basically, some kind of estimation is required and some kind of approximation is required, and you try to calculate a rate using an NPV rate which gives a positive NPV, and you try to calculate the NPV using a rate that gives a negative NPV. So once you have both a positive and a negative NPV, then the rate where NPV will be 0 will be somewhere between these two rates. So some kind of approximation and estimation. And by the way, to arrive at the IRR, usually for the purpose of comparison, the NPV doesn't have to come down really to exactly 0. So long as it is a very small number, you know the rate is approximately what this is what the IRR is. So this is the rate, the IRR, which is going to give NPV which is equal to 0 when you take all the cash inflows and outflows, including the initial outlay, and that when discounted to the present value comes to 0. The net present value comes to 0. IRR can be found by trial and error using different discount rates. So that's how you have to arrive at the IRR. You have to make an estimation, and we said trial and error. You try one rate and you see what the NPV is. If the NPV is positive, that means you need to try a higher rate in order to get a negative NPV. So trying one rate, getting an NPV, if it's positive, then you try a higher rate, and we say, for example, you try at 25%, and if 25% gives you a positive NPV, then you try to calculate the NPV at 35%, and that might give you a negative NPV. So that will give you an idea that the NPV must, therefore, the IRR is going to lie between 25% and 35%. We can look at this by looking at an example. Calculation of IRR. If we use a 25% discount rate for project A of the Bannu company, we get a positive NPV of rupees 84,800. We apply a higher rate of 35%, and this gives a negative NPV of rupees 66,530. Now we are using the cash flows in our example of the Bannu company. In that example, if we use those cash flows and apply a rate of 25% to the project A cash flows, our NPV is 84,800. This is a positive NPV. And then we raise the discount rate from 25 to 35% and see what happens to NPV. And here we find the NPV is going to be a negative 66,530. 4,530. So with a positive and a negative NPV, we know the IRR, where NPV is 0, will be between 25% and 30%. So there is a bit of trial and error involved. That means you try one, get the result, you try another, get the result. Now you might want to try 28%, see what the NPV is. Then you want to try 32%. So there is a bit of trial and error involved in estimating the IRR. In fact, in our example, we then use 30%. And let's see what happens. Hence, NPV will be 0 somewhere between 25% and 35%. In fact, at 30%, the NPV is 4,540. So we said that if the NPV is a small number compared to the other numbers at 25% and 30% and 35%, then we are going to use that as an approximation, and we don't have to get right down to the exact NPV 0. So when we on our cash flows try 30% for the NPV, we get NPV of 4,540. This is a small number compared to the 84 and the 65,000. So we are going to say that this is nearly acceptable, and therefore the IRR is around 30%. And essentially we are trying to arrive at an approximate rate of return to make our decisions, to base our decisions, to see approximately what the return is going to be. Don't forget that the cash flows which are giving you the IRR are also projections and estimates. So these are not, in any case, actual events, actual figures, 100% correct, 100% accurate. These are estimations, and so is the IRR. Relevant cash flows. Like other decisions, investment decisions should be based on cash flows that are directly attributable. The concept of relevant information, relevant cash flows has been discussed earlier in different topics. The same concept applies here in capital budgeting. When you are looking at capital budgeting and you are evaluating the projects, you are looking at the cash inflows and outflows. Inflows is the revenue and the income that comes into the organization. Outflow are the expenses and other expenditure incurred where cash is going out of the organization. So in looking at the inflows and outflows, we are then going to arrive at a net position, and we are going to look at the net position, but these cash flows must be relevant to the project, so that they must be directly attributable, means that they must arise out of taking the decision to invest in the project. So these should be those cash flows which, if we did not take the decision to invest in the project, then these cash flows would not exist. So these are the relevant cash flows. They are also called the incremental cash flows. Incremental, additional, new, relevant. This means they relate to our decision. They would not be there if the project was not accepted. So those differential or incremental cash flows must be considered when you're looking at and evaluating the projects. This means that if a cash flow already exists and it continues to exist, and this can be, take the example of some expenditure. If a new project is being added, if a new project is going to incorporate a new product and some new machinery, but the production manager in charge of the entire facility remains the same, and there is no new separate production manager for the new product, then the cost of the production manager, his salary, etc., is irrelevant to the project. The project has not resulted in any new or additional cash flow with regard to the manager's expenditure and his salary, etc. So that salary and that cost would be irrelevant to the project. However, if we are going to take on a new production manager just for this new production line and new product, then the cost of that new production manager is going to be relevant cost. So that's what we mean by looking at directly attributable. If the cost can be directly attributable to the project, if the revenues can be directly attributable to the project, then those are the cash flows which need to be taken into account and evaluated using our various techniques. These will be the incremental cash flows that occur if the project is accepted. They will include cash savings in current outflows, relevant cash flows, new cash flows, incremental cash flows. These are the cash flows which we are saying that we are going to take into account. It may be that the project that we are taking and the investment that we are making is going to result in the improvement of our process. It is going to make the process more efficient or faster or better quality. So if we can save the cost of our existing production and existing operation, then that cost saving is relevant cost. So we have a production line, we are producing a product at the end of the production process. Now if we change the process and implement and establish a new production line or an improvement in the production line with perhaps some new equipment and more modern and faster equipment, then perhaps we'll save costs that we are producing. The product is the same, the people working there are the same, but we change the equipment and we get a newer and faster machine so that it reduces our cost. Then this cost saving is going to be included in the relevant cost and in the cash flow of the project. This is basically an efficiency, therefore an efficiency improvement project. So the project can be evaluated on the basis of cash flows that result from the project, and they will include any efficiencies and reduction of current cost. Depreciation is a non-cash expense and not included in the cash flows. The capital investment is included in the cash outflows, usually at the start of the project. Depreciation is also a topic which will be covered in the financial accounting syllabus and financial accounting courses. We are going to refer to it from the perspective of our cash flows, that when you make an investment, usually the outflow and usually the investment is made at the start of the project. You either buy a new machinery or you have a new process or something like that. So the investment is incurred at the start of the project and the returns are expected in the future. Depreciation is going to be, as you know, calculated on the cost of the investment, and it will be calculated using one of the methods acceptable under the accounting standards, either the straight line method or the reducing balance method. And then this depreciation is going to form part of your expenditure and income statement. But this depreciation is a non-cash expense. So in our cash flows, we will not include depreciation. It is not a cash flow. Depreciation itself is not a cash flow. The investment to purchase the asset is the cash flow. That's where you are buying a new asset. So the entire investment and the purchase of machinery is going to be included in the cash flow, and the related depreciation which is an allocation and not a cash flow item, it will not be included as part of the cash flow. Timing of cash flows. The calculation of NPV and IRR is based on the assumption that any cash flow in the future years will occur in one lump sum at the year end. Obviously, this is unrealistic. In our calculation, for calculating the NPV or the IRR, we are taking our cash flows, the net cash flows over the period of the project. Now, in these cash flows and in these examples, we have been assuming that the cash flows will arise at the end of the year. So each cash flow, if we say there is an income, we expect that it will arise at the end of the year, so we discount it for 1 year. So year one cash flow, we discount for 1 year. That means it is arising at the end of the year, all the cash inflows and the outflows. Cash flow for year two is discounted for 2 years. So this means we are assuming that it is arising at the end of the second year, and so it has to be discounted for a full 2 years. This, of course, is not how in real life practically the cash flows will be. All your inflows and outflows at the end of year one, and then all your inflows and outflows at the end of year two, and so on. This is, as we say, unrealistic. It won't happen like this. So we are taking this as an assumption. We are assuming this. So this is an approximation in our calculation. So there are ways in which to make the calculation more accurate. So this is an estimation, an assumption, and this has to be borne in mind when we are calculating our NPVs and IRRs. They are based on cash flows assumed to be occurring at the end of the period. So year one cash flows are discounted for 1 full year, and so on. More accurate method is to assume monthly cash flows and monthly discount rates. It would be more accurate that the cash flows, instead of being year one, year two cash flows, they are broken down into monthly cash flows, so that we have cash flow at the end of the month, one, discounted for 1 month. Cash flow at the end of month two, discounted for 2 months, and so forth. And of course, just like we have an annual discount rate, we can have a monthly discount rate. So using a monthly discount rate and using monthly cash flows is going to be a bit more accurate than the annual ones. So you are going to build in a bit more accuracy when you look at the cash flows on a monthly basis instead of looking at an annual basis. The rate, and it is not a completely simple division by 12 to arrive at the monthly rate. It has to be on compounding basis. So you can use a monthly rate and use monthly cash flows to provide more accurate returns and accurate information of projects to base your financial decisions on. However, annual cash flows are easier to handle and do provide a good estimate for most decisions. These are, as we have mentioned, estimates. You have some ideas about improvements either to existing processes or products, or bringing in new products and new technology and other improvements, and you are projecting what will be the effect. Now, those projections are based on calculations, etc., and other research perhaps, but they are all estimates. So if you are estimating and then you are projecting a rate and projecting cash flows, then using an annual cash flow is an easier thing to handle. It's much easier to just take the annual cash flows, especially if it's a long duration. I mean, if you have a project that is going to provide returns, let's say over 10 to 15 years, and if you start to break that down into months over 10 years, then it becomes very cumbersome and detailed and a lot of calculation. So making use of annual cash flows to provide a basis, to provide an approximation to base your decision on, and that is usually how it's done in practice also. People usually base annual cash flows and use annual returns to make their decisions. And usually in making the decisions, that little bit of margin may not always make the difference to the decision, and therefore decision making is done on that annual basis. Comparison of NPV and IRR. In many situations of conventional projects, the IRR method and the NPV method will result in the same decision. Conventional projects are those where an initial cash outflow is followed by a series of cash inflows. So we have discussed two basic techniques of evaluating projects for our investment decisions. One is the NPV and the other is the IRR. Now let's have a comparison of the two. When you compare them, IRR you look at and see what rate you get and see whether the rate is acceptable. For NPV, you calculate the present value and you see, first of all, if it's positive at the discount rate that you want, and secondly, if it's positive, the higher the positive number, the more acceptable the project becomes. So conventionally and ordinarily speaking, both NPV and IRR will give the same decision in whether to invest or not and whether the project is viable or not. If you use either of the techniques, it is going to give you usually the same result. When we say usually, we are here considering what are conventional cash flows. Conventional cash flows means normally what happens with these new projects. Normally, it will be that the investment will be made at the current time, and the returns and the inflows will occur in future over a number of periods. This is conventional cash flow, as opposed to, and this can happen, but what unconventional, what would that be? That would be if you have cash outflow here, then inflow for a short while, then outflow again of another amount, and then some inflows and outflow again. So if you have inflow and outflow, and when we say outflow, I mean net outflow, and that is going to usually occur where you have to make capital investment in different times during the whole period. So that would be a slightly different cash flow where the capital investment is not all in year current period. It is spread, say, partly in the current period and partly in period 2 and partly in period 4. If that's how the investment is spread, then the cash flows will be slightly different. It will not be cash flow, a lot of outflow in year 1 and then a stream of inflow over the period. So using conventional cash flows, normally comparison of NPV and IRR should not be a problem, and they should give the same result. This applies where the projects are independent of each other. However, there are situations where the IRR method may lead to a different decision from those given by the NPV method. The additional thing we are saying here is that this applies where the projects are independent. Now, what does it mean? The projects are independent of each other. That means that you are making the decision of one project only. It is not dependent on the decision of any other project. So here is the project, you want to decide whether or not you should accept. What would be a case where they are not independent? That would be if there are 3 projects, and whether or not you decide to accept project 1 will depend on whether or not you accept project 2. So then the decision is dependent. And especially where you have to choose just 1 out of the 3. So then if you accept 3, that will depend on whether or not you accept 1 and 2. Because if you do, then you will not accept project 3. So this is how they can be dependent on other projects. So if they are independent, means one project and you are making the decision, there will not be any confusion between NPV and IRR. But as we are saying, there could be situations where the IRR and NPV will give a different decision. So it is possible that on the basis of IRR, you choose one project, but evaluating on the basis of NPV, you might be guided to choose another project. And how will we then decide which one to accept, which decision is better, which technique is better? Let's look at an example. Mutually exclusive project. Mutually exclusive projects are those where acceptance of one project would mean exclusion of another. For example, the choice of a factory location or one of many different machines. So a mutually exclusive project is that project where the example we used is a location for a site, the factory location. There could be 3, 4, or 5 different factory locations being considered, but you will only choose one of the locations and you will not choose the other. You will just take one location. The factory will be located on any one of the 3 or 4 or 5 different choices. Similarly, if you want to start a production process and you need to acquire machines, there might be many different types of machines available for that process, but you have to choose just one. So these are mutually exclusive projects. That means they are exclusive. If you choose one, then you do not choose the others. These are the conditions that we are going to then compare the NPV and IRR and see whether they will give the same decisions, and if not, then which technique to follow. In this example, the Bannu company is evaluating 2 mutually exclusive methods of improving marketing of its products, Project X and Project Y. The estimated incremental cash flows are: Project X outlay in the current period 700,000, year 1, 2 and 3 the net cash flows are 343,000 every year. Project Y, the net cash outlay is 1.2 million and the net cash inflows in years 1, 2 and 3 is 552,000. The company's estimated cost of capital is 10%. Which project should the company accept? So this is an example of a mutually exclusive projects, X and Y. There are 2 projects. They have 2 different outlays and 2 different cash flows. We are told the company's cost of capital is 10%, so we use that for discounting. Which project should the company accept, X or Y? Let's do that by calculating both the IRR and the NPV of the project and see what happens. NPV and IRR calculations. Here, the IRR of project X is 22% and that of project Y is 18%. So, project X has the higher IRR. When we look at the NPVs of the 2 projects, X is 153,041 and Y is 172,824. So according to NPV, 172824, project Y has the higher NPV. As can be seen, the IRR is higher for X, but the NPV is higher for Y. So this gives you an example where we need to compare the two NPV and IRR. These are mutually exclusive projects. That means if you do one, then you will not do the other. So either you can do X or you can do Y. Which one should you do? According to the IRR, project X has the higher IRR. So you should use and accept project X using IRR as the basis. But if you use NPV as the basis, then project Y has the higher NPV. So you should accept project Y if you use NPV as the basis. Now, one of these two methods is giving an incorrect indication. We have the same cash flows for under both methods, and using the same cash flows and the same discounting of 10%, we find the decision is different. So in these situations, let's see what is the more accurate method and technique to use. Which one should you accept? If the projects were independent, both would be accepted. Here, the ranking is crucial since only one project can be accepted. This is the difference where we are looking at mutually exclusive projects. Independent projects, what would be your decision? Your decision would be your cost of capital is 10%, IRR of 18 and 22, both would be acceptable. Independent projects using NPV is positive in both the cases, so both projects would be acceptable. Now we need to choose one, so we have to rank, and the ranking is now different for the different techniques. Incremental cash flows. One method must be indicating the incorrect ranking. In fact, the IRR gives the incorrect ranking. This is proved as follows. We use the cash flows of project Y and project X, and we calculate the incremental cash flows, which is the difference between project Y and project X. In other words, project Y minus X. And we arrive at the cash flow. Here, the difference, initial outlay is 500,000, which is the difference between the 1,200,000 of project Y and 700,000 of project X. And similarly, the cash flows for the 3 years is 209, which is the difference between the 552 and the 343 of the two projects. So here, the technique we have used is that we have calculated the incremental cash flow between the two projects. This is a technique to demonstrate which is the better technique for evaluating the projects. Incremental means additional. So we take the two projects X and Y, and we subtract the cash flows of one from the other to find out what is the difference. And that is the differential or the incremental cash flow. Now that cash flow on its own is going to be discounted and seen whether that cash flow is an acceptable under the discount rates that we have used for the project. If the firm adopts IRR and chooses project X, we can consider whether it is worthwhile to add the hypothetical incremental investment Y minus X. Hypothetical incremental investment. So this incremental cash flow of Y minus X, the difference between the two projects, is a hypothetical investment. We treat that as an additional investment, and hypothetical, that means not real. It is not a project, but we just assume that to be a project and look at all the cash flows. First of all, the additional outlay, and then the annual cash flows. And then we evaluate this as a separate project. This is the equivalent of accepting project Y. The IRR of the incremental investment Y minus X is 12%. as the cost of capital is 10%, the incremental project should be accepted. So when we then evaluate this incremental project, hypothetical and not real, but just an assumed project of the difference in cash flows, we find that the IRR of this is 12%. Now, since the cost of capital is 10%, our decision here would be to accept this incremental. So we would accept project X, and we would also accept incremental, and therefore this is the same as we have accepted project Y. And so our decision using the IRR and adding the incremental would be to move from X to Y. So we would be accepting the project Y. And that indicates that we are accepting the NPV basis and not the IRR basis. And therefore, where there are mutually exclusive projects, there the NPV must be calculated and it should be given preference as the basis of decision making. And IRR indicates we should move from project X to Y, hence NPV is a superior method. So here we conclude that in comparison, we should prefer the result of NPV. This doesn't mean that we should altogether ignore or not take into account IRR, because IRR is very widely used, very commonly used. And so normally what you will see is that if there is a project, the organizations will calculate both the IRR and the NPV and then make their decisions, and giving, of course, greater weightage to NPV. Percentage returns. Another problem with IRR is that the result is expressed as a percentage and not in monetary terms. Now we look at another problem with IRR. IRR is giving us percentages. What is the return of this project? What is the return of that project? And only looking at the percentage return. So when we look at the percentage return, we are not looking at the full monetary impact. So a small project might give an IRR of, let's say, 30%. A very large project might give an IRR of 25%. But a small project is going to have a small impact and have a small return in overall total financial terms, income terms. And a large project will have a larger, therefore, income impact. So just using IRR and just using percentages, it will tell you that this 30% is better than the 25%. But that's not always the case. So percentages alone are not something that should be looked at. The entire scope and entire size of the project should also be looked at. Consider an investment of rupees 10,000 that yields a return of 50% compared to an investment of rupees 100,000 with a yield of 25%. One has a return of 5,000, the other has a return of 25,000. So just to take our example forward, let's look at these two projects. One project has a return of 50%, and that involves an investment of 10,000. And the other has a return of 25%, which is half the return, but it involves an investment of 100,000. The 10,000, 50% will give a return of 5,000. The 100,000, 25% will give a return of 25,000. Now, if somebody had 100,000 and it went on the decision of the IRR, then spending 10,000 and accepting that project, then the other 90,000 would have to be invested at the cost of capital or the financial markets cost, and that would be 10%. So 10,000 at 50% will give 5,000, and the 90,000 at 10% would give 9,000. So that would be a total of 14,000 income earned from 100,000. Whereas the other project, which is giving a return of 25% on 100,000, would give 25,000 as a return. So that's what we are saying, that percentage alone should not be looked at. IRR is giving you only percentages. The whole project size need also to be compared. Payback method. This method ignores the time value of money, but it is frequently used in practice. It is defined as the length of time that is required for a stream of cash flow from an investment to recover the original amount invested. One other commonly used technique is the payback method. The payback method is a simple method. It is looking at just the payback period. It is just looking at how long it takes for the project to raise income, raise net cash inflows equal to the amount invested. That is the payback period, and this is going to be in the number of years. So if there are two projects and the cash flows, if you compare them, and the cash flows of one gives you the net cash inflows are equal to the amount invested in 3 years, this payback period is 3 years. Compare that with another, if that has a payback period, in other words, the net cash inflows, they add up and equal the initial investment in a period of 4 years, then the payback period here in the second case is 4 years. So the payback period basis will tell you to accept the projects with a shorter payback period. Of course, the longer the project, the more risk there is, the more chances there are that things will happen not according to how you have planned. Other factors will come in. So therefore, it is more risky. That's why payback, even though it ignores the time value of money, it is still very commonly used because it gives an indication of risk involved. If you can recover your initial outlay in a short period of time, then that is going to be a preferable project to undertake. So the payback period is one method which is very commonly and very widely used, despite some criticism that it ignores the time value of money. If the cash flow is not constant from year to year, payback period is determined by adding up the net cash flows in successive years until the total is equal to the original investment. So this is how you arrive at the payback period, that you keep adding up the net cash flow from year to year without taking into account the time value of money or any discounting rate. Simply the cash flows are added together until they reach and the amount is equal to the amount invested. That is the period which is the payback period. And people regard that as a very important period, a very important information, and the basis on which to make their investment. That's all for this session. Thank you very much for listening.